yes, there is a mounting evidence of a slowdown, but very little evidence of recession, especially stateside.
Okay, so first from the US, indeed, there's no signs of a slowdown, I would say. If you look at the weekly data in terms of GDP growth, Q3 is said to be pretty good. We actually expect 2.3% growth annualized. So really, the only area of softness in the US is really the labor market, right? It's been climbing up a bit over the past few months, currently at 4.2%. So this is what the FOMC members are going to watch closely. But again, we are not too worried or too concerned about the state of the broader state of the US labor markets. And the reason is why, when you look at the data a little bit, what you realize is that the weakness of the labor markets is not so much down to weakness of spending, or we don't have any evidence as well that US corporates are laying off workers. In fact, the layoff rate is still very low. Initial claims, unemployment claims are still very low, around the same level as they were back in 23. So no evidence whatsoever when the labor market is soft because of weakening demand, but it's more because of really a surge in supply of new workers, a surge of the labor supply. So lots of new people entering the labor market, and there's just too many people to be hired. So that's why the labor market, the unemployment rate is rising up a bit. So it's more a sign of, I would say, a healthy economy, but a weakening economy, if that makes sense.
So Maxime, that's absolutely fascinating then. So is the market wrong to expect, well, I guess it will get confirmation or not via the dot plot, but is it wrong to expect so many cuts, nearly 300 basis points of cuts by the end of next year?
Yes, we think they are wrong. We think the Fed will adopt a much more cautious approach with back-to-back 25 basis cuts in each meeting starting this week. So through July 25, we expect 25 basis points in meeting, which will take the Fed funds rate down to about 3.5%, right? So there's no rush. There are still a lot of tailwinds in this economy. Immigration is still strong, albeit it's slowing. Fiscal policy is still pretty loose as well. As I tried to explain, the labor market is not as soft as it appears. And also something very important, I think, is when you look at the state of the US corporate balance sheets, very solid. In fact, the net interest payment of US corporates as part of their profits is the lowest it has ever been. It's not something what you would expect after two years of very sharp monetary tightening. So no rush. The Fed should adopt a very cautious approach, because if they start to cut rates too aggressively, I think that would send a very negative signal to the markets. And there's also the risk that financial markets will overeat, will be just overly optimistic, and that would take financial markets through the roof. I don't think this is something the Fed would like to see.